Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. First and foremost, as always, a very big thank you to Fox Business Network, Maria Bartiromo for including us last week on Fed Day. This continued journey of interest rate policy coming out of the pandemic, excessive rate increases of 2022 into 2023, and now the dialogue about the next move from the Fed, which is likely to be rate cuts. Rate hikes off the table for the most part, formally last week. And for us, we've been pushing hard against this March period of time. So a couple of things, right? Fed meeting, employment number on Friday. We sit down last night, 60 Minutes. This Fed chairman and the committee really for the most part, they've been very, very transparent, or they've tried to be very transparent about what their intentions are regarding policy within their control. In this pocket of time, if you listen to what Chair Powell is saying, if you listen to what the committee is saying, they're not saying that rates won't potentially come down this year. They're sticking more or less to their forecast of 3 rate cuts over the course of 2024. And coming out of the period of November and December of 2023, markets moved very, very strongly. Financial conditions loosened a lot and still remain very tight when you look at credit and you look at interest rates in general. If you look at equities, markets have done very good within this period of time. So they're not pushing back on the notion of rate cuts. But what the Fed chair is saying is they want more time. And if you look at it practically in 2 ways. One, and last night the Fed chairman was very candid with saying that they just didn't get transitory right. They didn't get inflation right. And in late 2021, we had that ECI release, and we saw a strong pivot from Fed Chair Powell back then, and then what ensued in 2022. So pretty candid there in terms of not getting it right. So logically and philosophically, if you look at it, if you're not and you didn't get it right, on one hand, you're probably going to be a little bit more cautious now on the way down. That's what the Fed is saying. If you look at the 6-month PCE month-over-month readings and you annualize those numbers, the Fed is looking pretty good. They're in a pretty good spot. If anything, they're slightly below 2%. So Chair Powell is saying, look, the numbers don't need to get better. We just need more of them, and they need to continue to be good. And that's kind of where we're at. So we've pushed against this March period. The market now pricing in and around 20%. At one point, we were close to 100%. And with that, short end yields backing up here, the curve flattening out ever so slightly, long end yields a little bit above 4%. So the other thing that we're hearing from this Fed as well, and we're hearing a little bit of this today too, is the notion of neutral, right? What's the rate that runs the economy not too hot, not too cold? If you believe R star is still 0.5 with a 2% inflation target, the Fed still has their long-term neutral at 2.5. But given the pandemic, given the supply side shocks that we've seen, you look at the geopolitical environment that we have right now, certainly, Chair Powell pointed to some of those issues, whether it's the Ukraine, whether it's Asia, whether it's the Middle East now, whether you look at the Red Sea, you look at supply chain factors, you look at deglobalization within this period of time. It's undeniable that things have changed coming out of the pandemic. Those risks are still persistent. The Fed needs to take that into consideration. So what if the level of neutral is actually higher here? What if it's closer to 3%? So what we're hearing this morning out of Minneapolis Fed Kashkari is we have time here. Let's get more data. Let's let the data and the economy show us more where that level of neutral is at. Perhaps it's a little bit higher, because once we start coming down to that neutral level of interest, we want to be comfortable and confident where we think that level is. Friday's employment number certainly gives the Fed a little breathing room here. We get another claims number this week. We've seen the employment market historically change and turn on a dime. So we'll continue to watch the claims numbers very, very closely. But certainly the data and the numbers that we've gotten to start this year within our expectations. We thought the beginning of this year would be a little bumpy. We thought we would have some consolidation given the moves that we saw in November and December of last year. And the reality is, if you look at nominal 10-year rate, and we think the 10-year part of the curve is still important, very important in terms of financial conditions and even real interest rates. We peaked a little over 5% in late October in 10-year nominal yields, and this morning we sit down to levels that are 408 to 410. So we're still a full 100 basis points off the highs in yield. Credit spreads are tight. Equity markets have performed well. If anything, the dollar has strengthened. And the yield curve, although it's still inverted, 2-year versus 10-year, and we have favored steepening, and that curve has steepened out, it's still inverted, but we are steeper from the deepest levels that we had earlier in 2022, where we were trading in and around negative 108. On the ground this week, this morning, we are going to get the ISM readings, but most importantly this week, and the issuance calendar is off to a great start following Friday's employment number and the Fed meeting last week. Most importantly this week on Thursday, we'll get the CPI revisions, which go back 5 years, the seasonal adjustments that the Fed themselves will be watching very, very closely. Fed Governor Waller, in his last speech before the blackout period, referenced these CPI adjustments. So we think that will be the key piece of data this week. The Fed and markets both honing in on that as we continue to watch the inflation numbers on a forward basis. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.